So welcome to part 3 of my budget analysis for superannuation, and today we'll be dealing exclusively with the $1,600,000 balance cap. So fairness has been a real catch cry for these superannuation changes, and so it's not fair that you tinker with my super. Now, I guess that's one way of looking at it. We've retired, we expected these rules, but I don't think anyone can ever expect that the rules are never going to change. The tax is always going to remain the same. I don't think that can be the case. And most of our clients, when they consider it reasonably, if they've got $1,600,000 worth of assets that they can commence now to supply income for a tax-free pension, that seems reasonable when the excess isn't. You don't have to take it out of super. It's just the earnings get taxed at 15%, which is still a pretty favourable tax rate. So all the hullabaloo and carrying on, the people are there's going to be a max exodus from super. I don't think it is quite right, because 15% is still a better tax rate than anything else out there, really. So I don't think it's that bad. I think the main concern with this $1.6 million cap, transfer cap, is there's lots of thorns on how it's going to be implemented. So there's a lot of implementation problems and a lot of potential problems in trying to come up with the legislation that I guess will be surmountable, but could take some time. So I'm not even sure if it's going to get released in time for next year. So what is it? As an overview, it's $1,600,000 of assets for a member's account assets will allow to be, their language is transferred to a tax-free retirement savings account. So that means any income generated by that $1.6 million, and the $1.6 million can go up or go down, depending on what it's invested in, the earnings from that will be tax-free. The balance of earnings can still be held, I guess, in an accumulation account, but the balance of earnings, they're saying, will be taxed at that accumulation rate of that 15%. So that cap indexes in $100,000 increments in line when there's CPI increases that get it up to, a round figure of that $100,000. So in a few years' time, that cap might be $1.7 million. So if you haven't transferred any amount to a pension account at that point, a tax-free pension account, when you start that $1.7 million, it's $1.7 million if you do it in 2 years. Now, if, for example, you use 75% of your $1.6 million cap in 2017, when this is started to commence, and then that cap goes up to, say, $2 million from $1.6 million, well, you've used 75% of your existing cap, so you've got 25% of the new cap you can use. So 25% of $2 million, you can put, $500,000 in there. So that's how that works. Now, as I said before, fluctuations in those retirement accounts due to earnings growth or drawdown aren't considered when calculating the cap. So you could have an asset in there which, on the commencement of 1 July 2017, if it does in fact commence then, is worth $1.6 million, but potentially in a couple of years' time that asset could be worth $3 million and well over whatever the current cap is. You don't have to then take money out. You don't have to look at it on an annual basis. It's also interesting they talk about this concept of transferring to a retirement savings account. What does that mean? Does that mean there's going to be some kind of commutation of the pension? We're going to stop and restart that pension? And if that's the case, that could have some effect on Centrelink entitlements and, our pensions. There are some non-commutable pensions and those kinds of things out there. How would that play out? I guess we'll have to wait and see. So it'll become very important of, well, how are these things valued? So you have a look at, for self-managed super funds, the ATO's got those valuation guidelines for self-managed super funds, those comprehensive guidelines of how assets should be valued, what valuers to use. The interesting one is the date of valuation. So, okay, we want to start a tax-free pension under the new regime. So we've got to have a look at, well, what are our total pension assets and what are our total superannuation assets? What date do we look at there? Do we look at the last 30 June? Do we look at the last tax return? Or do we look at the actual commencement date of the pension? And if we're doing that, how do we get really to the minute information, especially with retail funds and industry funds? It's quite a role. So then I guess we can plan for that a bit too, as in we might be able to have some drafting of pension resolutions, much like we do with trust minutes, as in we don't know exactly what the trust income is going to be on 30 June of a year, but you can draft it so you can say, okay, there's going to be $1.6 million of the total amount of assets of the fund are dedicated to this pension account. If you've got a number of shares, etc., you could say that all those shares are going to be in segregated, and then such money from this account is going to be in that segregated account. So I think with formulas, etc., I think we can draft pension resolutions with some certainty and fix that capital amount in there for at least the tax-free pension. What we don't know is exactly what that amount's going to be in accumulation down the track. Funny business with valuation. So the ATO this financial year has said, look, we're really focusing on when there's been out of the ordinary valuation differences in the tax return. So if an asset value is significantly out of pattern, gone up or down. So if suddenly an asset's always been valued at one price and then suddenly it's valued a lot less, well, that'll send red flags in the ATO system, and I think an audit may be on the way. So be careful about trying to be too creative with valuations. Make sure you really got the supporting evidence to back any valuation. So how is this regime going to be enforced? So I guess it should be similar to refunds of excess non-concessional contributions. So if you have too much in that pension account, the excess is deemed to be transferred to accumulation, and then there might be a deemed tax on what the earnings is. There might be a deemed earnings amount. It's not quite clear in the budget papers. I guess another way they could do it is they just say, okay, well, $1.6 million is tax-free, and the balance is taxable, and we would just use a proportionate method of the earnings that are within that pension for what that balance is. If we did it that way, though, it's quite difficult for public offer funds, etc., to administer. There might be a deemed earnings rate or something like that on there. I guess we'll see in due course. Then what's the difficulty? It's going to be really, really hard for the large super funds to really get their house in order. When you think about this regime, the Labor government had a proposal to tax pension earnings in excess of $75,000, or if income was generated from a pension in excess of $75,000. And the complications in that meant they never really got around to legislating it. The goalpost changed, they delayed it. Now, with this, there's so many issues with this legislation. Let's say if the coalition government does get elected in July, and so then they proceed with these changes, you'd think, well, they have to consult with the industry. There'd be a lot of toing and froing and throwing, and there'd be quite a time, I'd imagine, before the legislation actually gets produced, and even more time before it gets passed. It's got to pass the Senate too. So you're looking, maybe that legislation might get passed in March, April 2017, if everything kind of went to normal plan. And then what? Then your large funds have got to update all of their systems to deal with, this massive change of reporting, and, it'll be continual tax return changes and member balance changes and etc. So they've got to get their software all prepared for this, which I think would take, 12 months or, years to really implement changes to this degree without it being full of bugs. So practically speaking, I really find it difficult to see how this is going to commence by 1 July 2017. Well, maybe, I guess, they figure there's another year before they've really got a report on that in tax returns, etc. So maybe they figure that the big funds will be able to get their house in order by then. But I wouldn't be surprised if this gets delayed. Now, I guess there's a lot of pensions out there. There's not just a standard account-based pension, which I think when the budget papers were released, that's all that was really considered in these budget papers. So your account-based pension is it's got a supporting balance, and then it earns an income depending on what assets are actually in that pension. And so that income, a proportion of that income's got to be paid out to the pensioner, to the member. So that's your modern form of pension. What about, well, you've got reversionary pensions, and so that's where you've got typically husband and wife. Husband dies, and so his pension automatically reverts to his wife. So, okay, if the husband and wife, both maxed out their cap, does that mean that it can't revert to her, or if it does, it'll cause her to exceed her caps, and there might be possible penalties for that? Don't know. We don't have the answer yet. That pension, the husband's pension, can continue to be a different pension, and it is really a pension that's relatable to the husband. There's more advanced pensions out there that people are doing where the reversionary pensioner's actually not allowed to stop that pension or commute it or bring it back to accumulation, and they're not even allowed to draw down more than the minimum pension payment. What will happen to those? So if they're not allowed to have them and they're not allowed to commute it back, well, maybe the legislation is retrospective if it's imposing pension penalties on existing arrangements. I'm not sure. Again, these are all the concerns. What about if a member dies, they can pay a pension to a child under the age of 25 who's living at home, or under the age of 18 otherwise. That pension's got to be commuted to a lump sum when that child turns 25. So in that case, imagine if you're a child and then you're getting this pension when you're 5, 6, 7, 16, and it was $1.6 million in 2017, and you can't really remember actually having a lot of money in your bank account from this pension. But then you're told, when you start earning some money, you're told, oh, you've already used up your entire cap for your pension because your parents started a pension for you when you were a minor. Doesn't seem quite fair, does it? Total and permanent disability pensions. How does the legislation deal with those? You've still got some of those old market-linked pensions out there. They don't have that kind of capital base. What about stuff up happens all the time. You don't meet your minimum pension payment in a year. Did the calculations wrong, you're busy with something else. So the TR 2013/5 says, well, the effect of that is that your pension stops and that pension account becomes accumulation. So what does that mean? We made a mistake. Okay, yep, we don't get tax-free status for that year. It's bad, but what's a lot worse is then we're never allowed to have a tax-free pension again because we made that mistake. What happens there? What if we want to commute or roll back a pension to accumulation? There's good reasons for that. Bankruptcy being one of them. Does that mean we can't start a tax-free pension again? We can only start a taxable pension. All these questions that we really don't know the answer to, and we're going to have to wait. Transitions to retirement income streams. In the next part, I deal with the changes to those income streams, but essentially it is, well, the earnings within super, they're now taxed at that 15% rate. So if you start a TRIS, does that therefore mean that that also forms part of the $1.6 million cap? You'd think not, but the budget papers don't really answer that question. And then, okay, does a TRIS automatically convert to an account-based pension if, for example, an arrangement in which you were gainfully employed came to an end and you were over 60? You'd have to look at the terms of that TRIS. And does that therefore mean it's a deemed transfer to a tax-free pension? Are there some pension planning strategies there? So have a look at that. Lots and lots of different pensions, lots and lots of different issues. So, like I said, the legislation and the industry consultation for this is going to be complicated and drawn out. So, I guess thinking ahead, and I wouldn't engage in any strategies or get too excited until you've seen some legislation, but just thinking about what might be able to be done is, well, you'd still be allowed to have segregated and unsegregated accounts. So your segregated account is, you might say, okay, I'm going to have this certain property and that's going to be my tax-free pension account. Or I'm going to have some certain shares and certain assets are all going to be in that tax-free account, and the other assets, there's other identified assets and bank accounts that are going to be in that accumulation account. So that's the segregated approach. The unsegregated approach is simply, well, X percentage of my assets, my members account, is based in a pension. And so you don't actually treat this one's a pension asset and this one's not a pension asset. So a lot of people are thinking, well, what are the best assets if we're going to use that segregated approach? What are the best assets to get in that tax-free account? Now, some people are saying, oh, you really want those high income earning assets because the income's tax-free. But I guess high income earning assets, well, they might not grow. Wouldn't it be great if you had that $1.6 million account in July 2017 and that really turned into, it was a big growth asset and turned into a $5 million account and generated that same kind of percentage rate of return on a greater base. Then you sell that asset and it's capital gains tax-free too. Wouldn't that be great? So I guess assets with the potential for a lot of growth would be great to segregate. There's been some talk, oh, what if you have a $3 million property? How do you possibly have use the $1.6 million cap then? Well, that's quite easy. You just have an unsegregated account. You don't need to have a segregated pension account. Now, what if you've got multiple pensions? So you might have a pension that's taxable and another pension that's tax-free. Which one do you utilise for this tax-free account? You probably, if you're going to have the balance in an accumulation account moving forward, you might want the taxable component actually being in your tax-free pension because you're going to use that up because you've got those minimum drawdowns. And you can sell assets within those tax-free after you die. And you might want the non-tax assets, to be in that accumulation base. So you've started off with a high non-taxable component in that accumulation. Alternatively, an even better way of doing it, so, when you revert assets back to accumulation, is you might do a bit of planning beforehand. So if you've got pension accounts which have got a high non-taxable component and you don't want them to get intermingled with the accumulation account when you transfer them back, you can have separate funds. So, a whole fund is really made up of largely non-taxable components. So there will be some real planning strategies moving forward. Then even, what about that, we get that growth asset, well, we want to make it that $1.6 million, we want to turn it into $8 million over the next 15 years. So can we get some conservative gearing? Can we do a limited recourse borrowing arrangement to acquire a growth asset under that tax-free pension account? And then we're saving some capital gains tax down the track too. So there will be strategies, they're just different. So here's a case study here. So Judy's retired and she's got $3 million members balance in her super. Judy earns no other income outside of super. So then Judy decides to hold the term deposit of $500,000, earning $15,000 a year or 3% per annum. She decides, I'll take that out of super and I'll put it in my own name, because if it's only $15,000, that's less than my tax-free threshold. And so she won't be paying any tax on that at all, rather than 15% if she'd kept it inside of super. So people will be having a look to really make sure they're utilising most of that tax-free threshold outside of super moving forward. Advisors have to be careful in this space though, is, well, Judy's already exceeded her lifetime non-concessional cap, so she might not be able to get any money back into super. And in the future, her earnings might be over that tax-free threshold, especially if she invests them in growth assets or she gets an inheritance or more money. So be careful with taking money out of super, because if all the changes go through, we might not be able to get it back in. Now let's look at the case of Mr. T. So Mr. T has a self-managed super fund with $15 million in the accumulation account and $20 million in a tax-free account-based pension. So Mr. T's done pretty well with himself. And Mr. T's an optimist, and he believes he lives in exciting times. So he's not fazed by these latest changes to his superannuation, even though it looks like he can't get as much tax-free as what he would have otherwise been able to. So Mr. T is quite a good investor, as you'd imagine from the returns that he's gotten inside of his super fund already. And he thinks there's 1,600,000 shares in an innovative fintech company, and he thinks they've got real potential for growth. So Mr. T gets his SMSF advisor to draft documents which commutes his existing pension accounts, so that stops them, and he commences a new segregated pension account, commencing with sufficient shares in that fintech company up to a maximum value of $1,600,000 as of 1 July 2017, subject to what the price per share is that the valuer comes up with. So Mr. T then engages a suitably qualified valuer to value those shares at midnight 30 June 2017. That came up to a value of $2 per share, or otherwise $3,200,000 for the whole company. So he gets half of those shares under that pension resolution are in a segregated tax-free pension account. The balance of his assets are all held in that accumulation account, and so the earnings there are taxed at 15%. So over that time, he gets a refund of all of the franking credits in relation to dividends paid from the fintech shares in his tax-free pension account. So he's getting almost 30 cents back there, and almost half of the franking credits in that accumulation account. So a couple of years later, after an initial public offering, those shares have gone up in value from, what was it, $2 a share to $20 a share. So Mr. T then, with his now $16 million worth of shares in that tax-free pension account, he decides to sell all of those shares, and he pays no capital gains tax on those. So he's made a hefty tax-free gain there. Even though his pension account is well over whatever the cap is at that point, it might have gone up to 1.7 million, might have gone up to 1.8 million, it might have gone up to 2 million, he doesn't have to return the excess of that back to the accumulation account. That's still $16 million is still all part of his transfer cap, because it was all generated inside of his tax-free pension. So Mr. T can reinvest that $16 million in a number of other startup companies in the hope that he can replicate those high returns. Mr. T decides to keep the remaining half of the shares in the accumulation account. So he keeps on to those ones, and even though he's paying 15% tax, well, he's actually getting tax back because the company was paying tax at 30 cents or 28 cents or whatever it is. So he's getting the balance of those franking credits back. So he's still getting a pretty good return in his super fund. Now, a variation to that theme might be, at the start, Mr. T decides to buy the entire $1.6 million of shares under that tax-free, 1.6 million shares under his tax-free pension account. And how does he do that without exceeding the cap? Because they're worth $3.2 million. He has $1.6 million in there, in the account that he funds, and he borrows the balance under a limited recourse borrowing arrangement. So if he'd done that instead, well, he would have got a higher return from this, and he would have therefore had approximately $30 million or so rather than $16 million in his tax-free pension account on IPO, because he had all of those shares in there. So you might see some creative planning like that going on. Give us a call if you want to discuss. Here's how you contact us if you want the paper or the slides. Thank you.